lower immediately following the open, basically flat now. Base models or new base models for the Model S and Model X are $10,000 cheaper than the prior generation. They have lower range. Remember, this is a low volume production vehicle. For Tesla, the S and X accounted for about 3.4% of overall deliveries in the first half of this year. But it does come 24 hours after you and I discussed Tesla cutting prices in China on the two variants of the Model Y, the long range and the performance, both cut by around $1,900 US. Tesla's not been afraid to use the lever of price cuts or introducing a new lower spec base model of these two S and X in a way to find new pockets of demand. And you and I have discussed this so many times that Musk and other Tesla executives are very clear that they are willing to sacrifice the bottom line and the impact to margins in order to protect that overall target growth rate of 50% annually. And this is another good example of that. But again, a lower volume production, and we're flat on the stock, Jonathan. It's a stock that's up 94% year to date.
Totally unchanged. Thanks for the update. Thank you, sir. Let's take it to the housing market. Warren Buffett's Berkshire Hathaway unveiling a big bet on US home builders. The company disclosing new positions in D.R. Horton, NVR and Lennar, together worth more than $800 million US. This according to their most recent 13F filings. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, home builders certainly rallying today following that vote of confidence from Berkshire Hathaway. We're talking about D.R. Horton, Lennar and NVR. Those positions were added in the second quarter. And of course, those stocks have been on a tear all year, given that big demand for houses has been met with a severe shortage of existing homes for sales. Now, in addition to these new positions, Evercore analyst Stephen Kim points out that Berkshire Hathaway already owns stakes in private home builders through Clayton Properties Group. So these new positions deepen that bet. And this was interesting, John. Evercore's Kim wrote that Berkshire's investment could help highlight, quote, the home builders' strong cash flows, healthy balance sheets, and favorable industry backdrop to a broader audience than the builder stocks have historically attracted. And you can see they're certainly seeing that love this morning.
Hey, Katie, thank you. Taking advantage of a frozen property market, the people with 2% mortgages don't want to move, and the people facing 8% mortgages can't really buy. Finally, hedge funds putting their faith in big tech and AI-related stocks. Institutional investors loading up on shares of Meta, Microsoft and Apple in the second quarter. Tech stocks accounting for the biggest weighting in the group's portfolios at 28%. Shanali Basak has more. Hey, Shanali.
Hey, John, if you think about the tech buying you saw during the second quarter, perhaps not surprising given what you saw in the moves in the NASDAQ, but you do have to take a look at exactly what people were buying. If you looked at the top 5 holdings, it actually wasn't all big tech. A lot of it was Amazon, one of the top 5 holdings. And outside of that, in the top 5 holdings, you had buying of the iShares U.S. Treasury Bond ETF as the top buy for the quarter, as well as iShares Core Total U.S. Bond Market ETF being the third. So bonds being 2 of the 3 biggest equity buys in the ETF land when you look at what funds were buying. Now, we also have to talk about the movement we saw during the quarter, because hedge funds, as we know, are not static. 13Fs go through the end of the second quarter, and it has been weeks since then. So it is just as important to look at what people were selling as it was what people were buying. And you did see some of the biggest tiger cubs in the hedge fund land sit and start to pair their stakes in some of the biggest holdings. You also saw some of the biggest billionaire family offices also pair their stakes in massive tech names. Soros Fund Management exiting, Alibaba exiting Alphabet, Stan Druckenmiller's Duquesne also exiting the likes of Alphabet and AMD. So you did see some selling, but again, people were nipping back in the market at the margins here during a very healthy moment in the market.
Shanali, you know it's that time of the year. We asked the same question. How useful are 13F filings?
Not very, because they are old. However, the direction of travel is important to watch here. In addition to the 13F filings, we had also recently, for example, John, gotten a note from Goldman's Prime Brokerage that is putting out their outlook for the rest of the year. And it says a lot of what we see in the 13Fs, where it's credit, it is bonds, it is not equities. That is the biggest question and the biggest kind of point of excitement here for the biggest investors.
Shanali, thank you for the update. We're about 6 or 7 minutes into the session. Equities are lower here by 0.4%. Not quite as bad as it looked earlier on this morning. Similar story in the Treasury market. Yields were much higher, now higher by just a couple of basis points, the 10-year at about 421. Tony Dwyer of Canaccord recommending equity investors stay patient, writing this: the time to be bullish maybe when bad news becomes bad news. The better economic performance reinforces a recession over the coming quarters because it keeps the Fed's rates higher for longer. Historically, the catalyst for forward growth is a much more favorable outlook for money that only comes with a rapid drop in rates. Wait for the clouds to clear. Tony, I'm pleased to say, joins us right now. Tony, is that another way of saying this soft landing talk is also bad news?
So, John, I've been kind of public with, I think the soft landing scenario is the worst case scenario. And the reason is because it keeps rates higher for longer. When you're in a generationally levered system on debt to GDP, the longer that you keep rates elevated, the more interest expense you're going to have over time. For example, let's just think of common sense, for the viewers and the listeners. How many people have you heard get loans in the last 3 years where there was no interest payment for a year? So all of a sudden you fast forward and your interest payments could potentially be a lot higher. And I think ultimately that's why people, like you said, are stuck in their house. Mortgage rates, listen, you need an improved outlook for money. When I look at the soft landings of 1995 or 1966, in both of those cases you had a 200 basis point drop in short rates. We have government interest rates at the same level as a year ago. Corporate interest rates at the same level as a year ago, mortgage interest rates at the same level as a year ago. So let's even assume a soft landing can magically happen. What's your next catalyst for double-digit earnings this upcoming year? And I know people would say, well, productivity, and certainly that could help, but you really need a revenue pump, and I don't know how you're going to do that with money where it is.
Tony, these issues around rates, do they speak to the recent developments in the bond market? I've asked this question a few times over the last week. Just what is the dominant factor underpinning this bond market move, with yields back up to about 4.20 on a 10-year and close to 5% on a 2-year?
Well, I got to say, it happened right after Janet Yellen announced an increase of 1/3 in Treasury no issuance. I mean, you're financing paper now at over 5%, no matter where you are on the curve. That was zero. It was 0.5%. So the issue that we have here is, for a generation, the refi cycle is probably broken, because I look at my own household. I have a 2 7/8 mortgage. For me to be able to refinance that mortgage and take money out and do it affordably with anywhere near the same monthly payment, you're going to have to get the 10-year back down toward 1%. And imagine what the employment picture would look like if that's the case. So, there are some offsetting positives. This is, sounds Armageddon negative. The offsetting positives can be that private credit is kind of stepping up into a place where the bank credit is falling.
Listen to you, Tony, showing off. I've got a 2 handle on my mortgage. Tony, that's like saying you've got a Lamborghini on the drive in 2023.
But I'm pretty good at being wrong in the stock market, but my mortgage trades have been
Tony, you're kidding me. I wish I had a mortgage with a 2 handle, locked in for 30 years. Tony, I've had a lot of people tell me that we can't sustain life above 4% on a 10-year, that this isn't sustainable. Do you endorse that view?
I don't think it's sustainable. John, for example, this morning, I have this great research assistant. His name is Google. So I just Googled, strong retail sales, and better than expected prior to recession. I went back and I looked at 2007. In November 2007, you had a huge move up in retail sales, and the reason was better than expected income growth and full employment. Better consumer confidence. So, all you have to do, I believe, in this thing is try to maintain patience. And what we're going to do all day, unfortunately, you have to do it and I have to do it. We have to comment on what the stock market's doing in this half hour. And what we found over the course of this year, last year, and the year before is that intraday volatility has become so extreme. I think that information is useless. What is useful is, where are we with employment? And that's been pretty good. And where are we with interest rates? And that's not so good. So ultimately, when the higher interest rates, if they stay higher for longer, do bite into the interest expense and companies have to pull back a little bit, that's when the unemployment picture starts to rise. That's when bad news becomes bad news, and that's when I want to attack. The time to be seriously negative, in my view, was last August, and man, did I feel dumb last August. Market was ripping, and as you remember, I'm sure you remember, I was pretty negative, feeling really wrong, and then we went into the October swoon as rates started to really ramp. Now I believe is the time, as stocks pull back, John, to try to take advantage when bad news becomes bad news, because that's when the outlook for money improves as the Fed cuts rates.
Tony, do you feel a repeat of that late summer story coming into September last year?
I think you got a buffer, John, and I think part of it is, like, for example, 3 or 4 months ago, nobody in China was talking about a 100 basis point rate cut. So, things change fast when unemployment starts going up because it becomes a political influence. So, yeah, I do think we can have a sharp sell-off. I don't think we're probably going to go back to the October lows. You don't need to. I think a good enough sharp sell-off that really comes from worse economic data and the employment picture that helps the Fed really in expectations for Fed rate cuts have the 6-month, the 2-year come down hard. I mean, think about this, John. You and Lisa earlier this morning did a great job of talking about mortgage paper. So we're at a 7.25 on a 30-year fixed conventional mortgage. That comes because there's a historic spread, wide spread between 10-year treasuries and mortgages. If you have the Fed cut 100 basis points, and if you have that spread go back to a more normal level, if you stop QT or at least pause it, then all of a sudden you got a 200 basis point drop in mortgage rates. And when that happens, you can really kickstart maybe the next economic cycle. I don't know how you're going to magically do it without a real drop in rates.
Tony Dwyer, Chief Market Strategist at Canaccord and owner of a 2% mortgage. Tony, thank you, sir.
2 7/8, buddy. 2
7/8.
Just very close to.
I'm making it sound even better for you, Tony. Go away. Tony, thank you. I'm so jealous, honestly. The mortgage envy is real. Your equity market on the S&P 500, slightly negative this morning. Coming up, Secretary Yellen leading the Bidenomics PR tour.
The administration remains committed to taking actions to lower prices for Americans where we can.
That conversation coming up shortly.
The administration remains committed to taking actions to lower prices for Americans where we can. And we continue to monitor developments, particularly those abroad, that may affect prices and growth.
Secretary Yellen praising the president's economic policies in Las Vegas. The administration celebrating the one-year anniversary of the Inflation Reduction Act, with Vice President Kamala Harris speaking in Seattle. President Biden addressing voters in Milwaukee at 2 p.m. Eastern. This all ahead of his big speech Wednesday from the White House. The president trying to ramp up voter support as presidential candidate Donald Trump gets indicted in Atlanta over efforts to overturn the results of the election defeat in Georgia.
The indictment alleges that rather than abide by Georgia's legal process for election challenges, the defendants engaged in a criminal racketeering enterprise to overturn Georgia's presidential election result.
Let's get to the Bloomberg team. Kelly Lyons and Mario Parker joining us down in Washington, D.C. Mario, first to you. What's the latest, please?
Well, the framing that you had in your introduction, Jonathan, I think was spot on, right? You got President Biden going to Milwaukee, a city and a key swing state, to tout his economic agenda ahead of the 2024 election. And you've got former President Donald Trump down in Georgia, another key state, with the latest indictment. One thing to be sure about with former President Donald Trump and how he's using these indictments to try to capitalize and fuel his political comeback is that they're indistinguishable at this point from his campaign.
Katie, is this just drowning out the campaigning of President Biden on his Bidenomics tour, or is it helping him?
Well, it's hard to compete with the headlines, right, John, as so much media attention has been placed on the legal woes of the former president. But the current president is trying his very best, not just him, but others in the administration, other surrogates on this 10-state swing this week to celebrate the one-year anniversary of the Inflation Reduction Act. As you pointed out, there will be an event at the White House tomorrow. But before that, today, the president will be in Milwaukee, Wisconsin with this message. It's important to note the significance of that location choice as well. Wisconsin, of course, is a critical swing state. He won it by a narrow margin over Trump in the 2020 election. And the city of Milwaukee is also the location of the first Republican primary debate that is taking place next week. Now, as for whether or not this messaging really is going to resonate, to this point, despite what the president has touted as growth in the economy from the middle out and bottom up, it isn't necessarily showing in the polling. Still, a majority of Americans disapprove of his handling on the economy. That is consistently shown in surveys. His approval rating also remains low overall, and so that is what this tour really is intended to rectify. But definitely some oxygen being sucked out of the room by his likely opponent in a general election if the current stance of the race holds
Mario,
as it is now, John.
Can you jump in and translate this for me, this headline that crossed from CNN just moments ago, that Hunter Biden's top lawyer has asked to withdraw from the case? What does that mean, Mario?
Well, it means that now we've got the former president kind of dogged by investigations, and it looks like the White House, much to its chagrin, from where they were thinking things would be at least 2 weeks ago, will also have an investigation kind of hovering over the 2024 election as well. This isn't great news for the president. I mean, Republicans, going back to the 2020 cycle, have tried to make his son, Hunter Biden, a focus of their attacks, and it's a weak spot for the president going into 2024. It allows Republicans to engage in whataboutism, as to Kaylee's point, as former President Donald Trump is embroiled in his own investigations.
That headline just crossed in moments ago. Mario, Kaylee, to the two of you, thank you. Just to share that with you again from CNN, Hunter Biden's top lawyer asking to withdraw from the case. Plenty more on that, of course, on Balance of Power a little bit later at 5 p.m. Eastern Time with Katie Lyons and Joe Matthew today. I'm told that Anne-Marie's going to be back tomorrow. About 21 minutes into the session, we're down by 0.6% on the S&P 500 with a sector price action. Here's Abby.
And with that sort of decline, John, we are looking at all 11 S&P 500 sectors lower today, led by energy down 2.1%. We also have materials, financials down on the bottom, down more than 1%, joined by utilities up top. Interestingly, technology down just 0.1% or thereabouts. However, on the month, it's a different story. So the month of August for the S&P 500, we're looking at a greater than 2% decline. That's the worst month of the year, and this is one of the worst sectors. Technology down 5.4%. Earlier, I was talking about those stealth sell-offs for Tesla, or at least the degree of them, and NVIDIA. Well, this index is also heading to its worst month right now since December of last year, John.
It's had a tough go of it over the last few weeks, that's for sure. Abby, thank you. Coming up on this program, your trading diary. "25 minutes into the session, it's certainly not as bad as it looked earlier on this morning off the back of more weak data from China and a rate cut in the mix as well. We're down about 0.6% on the S&P 500. Not as bad as it was, because it's not as bad as it was in the bond market too. If you switch on the board and get to the bond market, yields are right off the highs of today, with a 10-year yield right now at about 417.57. A 2-year, that yield's declining now to about 492. Only an hour and 30 minutes ago, that was through 5%. Very, very briefly. Since then, we've backed away. So that sell-off in the bond market slowly getting bought in the last 30 minutes or so. That's the price action. Here's the trading diary. Coming up, the Fed speak from Neil Kashkari of the Minneapolis Fed. That will take place at 11 a.m. Eastern Time. President Biden discussing the U.S. economy from Milwaukee at 2 p.m. this afternoon, then delivering remarks on the Inflation Reduction Act from the White House tomorrow. Plus tomorrow, Target earnings before the opening bell, and in the afternoon, some Fed minutes in the mix as well. Walmart numbers and another round of jobless claims, they come on Thursday. And finally, we round out the week on Friday with Eurozone CPI. That rounds out the morning for me. Thank you for choosing Bloomberg TV, and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
Minutes into the U.S. trading day, Tuesday, August 15th. Here are the top market stories that we're following for you. You got DIY holds up. Home Depot beats estimates. A smaller project pick up. That stock is up over 1%. And retail sales also pop. Okay, I'm not spending, but apparently everybody else is. We see if anything can crack the consumer as wages stay high. And a pause for equities. You got stocks trading heavy. Bank of America says fund managers are overweight tech, the most since 2021. Is there even cash left to buy any dip here? From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Not as intense as it was a few hours ago, but we're definitely seeing a straight-up risk-off kind of move within the market.
DIY and holding up, those are two things you never want to hear in the same sentence, because it rarely does, to be honest. I'm just talking about it from personal experience. The consumer thing I think is fascinating. Look at what is happening. You've got strong wage data out of the UK. You've got Marks & Spencer, a stalwart of the British High Street, coming out and announcing really strong results. Over on your side of the pond, Home Depot, back to the DIY thing. The numbers look good. Yeah, structurally, I think there's a long-term positive story. But what?
But a couple things. I mean, one, gasoline prices are quite high. We're definitely over 4 in some areas at the Northeast here, so that's going to kind of eat into sentiment as well. And also, you get student loan repayments are going to kick back up. Yes, the Biden administration is trying to fix that or get ahead of it and provide more relief, but if that kicks up, that's going to dent spending too. It's like you can always make the bull-bear side.
I've been hearing about why the consumer is going to be slowing down for a very long time now.
I hear you.
It's not happening. Okay, that's not true, actually. The consumer is slowing down. If you wind the lens, the consumer is definitely slowing down. My point is that I think the consumer is going kicking and screaming. There's still savings. There's still a desire to spend. There's still all kinds of reasons why the consumer wants to spend. The services story kind of speaks to that. There is a slowdown, but it's a slow slowdown. And as I say, I think the consumer, the muscle memory is just to spend. And that continues to be the story. So our question of the day is a fairly straightforward one. Alex, isn't, but is the consumer fighting the Fed and by extension other central banks? I'm going to fold the Bank of England in here because it's definitely got a wage problem. Let's figure this one out. Joining us on the consumer side, Simone Foxman. Joining us on the macro side, Simon White. Simon, I'm going to start with you. I read your piece on the Markets Live blog. You've got to widen the lens, haven't you? The consumer long term is definitely slowing down, but the rate of change, rates have gone from 0 to 5. We've seen a huge tightening of conditions, yet the consumer is only slowing down gradually. Is the consumer fighting the Fed?
I mean, as you say, it's muscle memory. I mean, they are not going to suddenly, unless they absolutely have to, change their spending habits. I mean, it's what people do. It's second nature. Yep. Unless they've got a really strong reason not to. So what's clear, obviously, I think that a lot of people got this wrong. I got this wrong, that you didn't really appreciate the extent of the excess savings, not just in the US, but in the UK and the Europe. And I think a lot of that stuff maybe isn't even in the official statistics. I mean, there was a rumour in the UK that 50 billion was fraudulent money. So you've got other money that might be circulating through, that came from governments fraudulently, that's circulating through the system. So there's obviously stuff that's really keeping things supported, but you're correct. The trend is definitely down. It's just not as sharply as you might have otherwise would have expected.
Oh yeah, we definitely saw that here in the U.S. too with all the stimulus checks as well. Simone, you've been digging through Home Depot, the stock reacting positively. What did we wind up learning about the consumer? Like, is the consumer really pushing back on the Fed?
There's a lot of mixed messages here, because on one hand, while yes, DIY did hold up a little bit better than Home Depot maybe was thinking, there's still weakness there. There's still weakness on the pro side. So there is an overall decline, and that's why we saw comp sales down 2%. Admittedly, they weren't as bad as the 4% numbers that we were looking for. But I think, when you step back and you analyze a lot of the context that we've gotten from executives in corporate America recently, there are two different kinds of consumers. There's the high-end consumer that's traveling to Europe, that's making plans to travel to Asia, that has built up a lot of equity in their homes. They are going strong. And then there's a lower-end consumer, maybe a middle-income consumer as well that's suddenly going to have to start paying back their student loans.
Yep.
They're already limiting how much they're buying, whether at fast food or elsewhere, and they're really starting to see the pain.
Which then leads me, Guy, to sort of unions and how we've seen a lot of union agreements over in the UK. Here, we're looking at the writer's strike. They're going to meet again with Hollywood. We've had a trucker strike. Like, there's, like, yes, but we've seen that pay increase also. And if that kind of pay outpaces inflation, why wouldn't you keep spending?
Well, that's the story in the UK, isn't it? Believe you me, we know about strikes. We know about unions. We know about that narrative. It is developing here and continues to develop here. We're seeing some extraordinary pay offers being dished out. And Simon, this is the difference. I was talking to Jean Beauvais about this a little bit earlier on today from BlackRock, and he was saying basically what we are going through is what we're now seeing is a demographic shift kicking in as well. There is a shortage of workers. That gives labor more power. That means that we're going to see wage bargaining actually having an effect for the first time in years and years and years, and that is going to continue to support the consumer.
Yeah, I think that's a medium-term to longer-term trend that I could certainly buy. I'd say in a slightly shorter basis, I'd say certainly looking at the US, if you look at real wages, they're actually not that much different from what they were in 2016, 2015, and they're not that much above their long-term average. Leading indicators also expect wages to start rolling over now. So to get any of these effects really feeding through, we need to see this continuation in wage growth, because what's going to happen, of course...
But momentum's there, isn't it?
Well, the momentum's there from unionization, but obviously you have to look at you can have a number of different stories that we've heard about, but collectively, obviously, you have to see it in the aggregate data to know if it's got momentum, if it is going to push forward, and it would need to continue doing that so that you get that continued wage growth. But I'd say on the other hand, you still remember you've got costs such as mortgage costs are very high. You have consumer credit has been tightening. These things are very negative for consumption, so the wages thing will have to be counterbalanced with what's happening there as well.
Just to update you guys, S&P taking another leg lower, now off by almost 0.9%. Volume is light, but you have yields hitting session lows. Definitely evolving as a straight-up risk-off safety kind of session, except with the dollar, though. The dollar is trading a little bit mixed. Simone, you cover the retail guys. We get Target this week. We get Walmart. What are we going to learn about the consumer through that, whether it's a trade-down kind of consumer or looking at the lower end?
So Target should be really interesting. Expectations are pretty low there. This tends to gear towards a little bit higher income of a consumer, also that middle income space. So if they really underperform, I think the expectation here, first sales decline in 4 years. So if we get some outperformance, that would signal a much stronger consumer, but some of this might be idiosyncratic. Walmart's been a really interesting play too, because they have such a large food and grocery business. That has allowed them to kind of hold up, even for consumers that are pulling back elsewhere, so they get a really broad, sweeping view of the consumer. There, the issue's going to be margins. Again, food is a low margin business. Electronics, things like that are much higher.
Simon, final point to you. Alex just brought up what's happening in the markets. I'm trying to sort of rationalize what I'm seeing in front of me. I'm going to start with stocks. Is the stock market today signaling, and it's the middle of August, is the stock market signaling today that basically the Fed is going to have to do more? Is the stock market today signaling that the Fed is going to have to stay higher for longer? Is that the real message from retail sales? Is actually it's not the consumer fighting the Fed, it's the Fed having to fight the consumer, and maybe it's got to fight a little harder?
Yeah, I mean, at the margin, I think that will have something. I mean, you mentioned August. We've got very light volumes at this time of year. But yeah, if you want to sort of create a potential narrative, maybe the Fed will have to. I'm not sure that's the way things will ultimately end up happening. But certainly the way things are today, people are looking at these retail sales numbers on their monthly basis. As I pointed out earlier, I think if you look at a trend basis, they are still very negative. So it depends on a lot of things. But right now, I think that's a credible narrative, right? The market's looking at higher for longer again.
Yeah, fair point. Fun combo, guys. Thanks a lot. Really appreciate it. Simone Foxman, Simon White, thank you both very much. So we're going to put our question of the day, is the consumer fighting the Fed? Katrina Dudley, Franklin Mutual Advisors, investment strategist and portfolio manager, joins us now. Hey, guys, before we go, though, Hawaiian Electric Industries was just cut to junk by S&P. Shares extending decline now. They're now down about $20. This comes after a massive amount was wiped out of its market cap yesterday on those wildfires in Maui. It's the biggest provider of power and a utility company in Hawaii, Guy.
Absolutely. PG&E, you look at what happened there. We'll continue to follow this story, both in terms of the death toll and the impact it's going to have. How are they going to redevelop Maui? I think is a critical question as well that now needs to be thought about. This is Bloomberg.
the U.S. consumer still remains extremely resilient.
The consumer is strong. Very, very resilient.
Consumer sentiment is high.
Resilient consumer with their spending.
You're going to begin to see the impact on the consumer.
Demand cools just a bit.
The consumer is starting to show some cracks.
Excess savings is starting to be exhausted.
Savings are being worked down.
Consumers are accelerating their borrowing.
There will be some headwinds.
Student loans.
The consumer is going to come under increasing pressure.
Inflation, food prices, oil prices.
There are a bunch of debts coming due.
Rates start to materially weigh on consumer activity.
It's how consumers behave, not what they say.
So those are some of the guests that we've been speaking with on Bloomberg about the U.S. consumer, which I feel like we've been hearing and talking about for a very long time. So it brings us to the question of the day, is the consumer fighting the Fed, fighting the BOE, fighting central banks? Joining us now, Katrina Dudley, Franklin Mutual Advisors investment strategist and portfolio manager. Is the consumer fighting the Fed, Katrina?
I don't think we can think about it in terms of the consumer fighting the Fed. The consumer plays two roles here. The first is the consumer is the employee, and you look at those employment numbers, they are persistently, we're keeping low unemployment, and that's on one side of the coin, and the Fed's watching that. And you've seen comments that we maybe need to have some policies to loosen up the labor market. And then on the other side, you're right, that the consumer is the driver, because so much of our spending, 70% is consumer driven here in the economy. So yes, the consumer will be the driver of the Fed, but that's because they're playing those dual roles.
So what does that mean for an investor?
For an investor, I think that you need to take a step back and have a look at what we're seeing in terms of the commentary. Most of the CEOs that we were listening to on the second quarter earnings call were seeing really strong signs. I think 70% of S&P reporting companies actually beat estimates. So the quarter was strong, but they kept talking about this recession. And it's a recession that we keep talking about. We keep pushing off, and we keep pushing off, and we keep pushing off. So my question is, do we really need to have this recession, or actually can we just have a mild downturn and keep going?
Yeah, and actually, Guy, that really dovetails nicely to the Bank of America Fund Manager Survey report, where the majority of people now don't see a recession coming. Like, they're able to articulate a soft landing, which is why you've seen a lot of money go, the cash pile has been drawn down, money's going into stocks, money's going into tech.
Yes. But listen to the back end of that SOT string we just had, and student loans are kicking in, gas prices are going higher, mortgage costs are starting to have an impact as people can't put off moving, and they have to move, and they have to accept higher rates. The headwinds are growing, and Katrina, what do you do with those headwinds? Can you just ignore them? You don't think they're powerful enough? We've gone from 0 to 5% on rates. The Fed's now talking about keeping rates sort of higher for longer. Aren't there a series of quite significant headwinds that are gathering kind of into one that could knock this economy off course?
Look, I'm the daughter of a home builder, so I know the home building market well, and you talk about the rising mortgage costs because people are forced to move. Why are they moving? They're moving for a job, and they're usually moving for a job that's paying more money, and that means that they can afford the higher mortgage rates, or even if they're just moving for a job at the same wage, the way to adjust for higher mortgage costs is to buy a house that is lower in value. Maybe you need to go a little further out, but we just think that, yes, on a like-for-like basis, those costs are higher, but we think that the consumer will be able to adjust to them. And I'm probably more in the camp that consumers are moving homes because they're getting higher wages and better jobs somewhere else, and that will more than cover the higher mortgage bill.
So, Katrina, pair that with what we're seeing in the market then, because the market reaction is a bit confusing to me. I would have thought with that setup, we would see some some selling in the front end of the curve. Yeah, you'd see equities down because yields were higher, and you see the dollar move a little higher. What do you make then of the market today?
The market is really kind of balancing at the moment because they see a slowdown. I don't think that they're talking about they're seeing a recession. They're seeing a slowdown, and that's resulting in that tapering of the market and the tapering of expectations. But let's move over to the tech stocks, because that's really the 100-pound gorilla here that's been driving the S&P in particular. And I think that the narrative for tech stocks was very negative 12 months ago. And if you look at it today, people are just seeing the opportunities that are created. And that opportunity set is this confluence of both the new technology taking hold, as well as the fact that we still haven't solved this labor crisis. And so technology and capital are the two things that are going to step in and help us, because technology and capital will drive productivity, which means we can, as an economy, produce more with less labor.
That's a very long-term story. That's a structural story that you can invest in over the long term. Feels like you've got to be very nimble in the short term, though, to deal with a market that's really choppy. Katrina, I've been doing this a long time. I can't remember this level of uncertainty. Nobody, to be honest, really has a good idea of where we're going. Sometimes you can see kind of momentum taking us in a certain direction. Doesn't feel like that right now. What's your degree of certainty? How do you feel about, at least tactically, the short term?
I think tactically in the short term, we're a little cautious as well. We do see some of those pressures on the valuation side. But the good news is that companies can grow into those valuations, which is that balance that we have long-term versus short-term. Yeah. And we just keep coming back and looking at the narrative and just looking at the positives that are really weighing in here, which is the fully employed, the full employment number, which is a positive. Mm-hmm. The housing market has continued to be positive. Real wages continue to be positive. And the job numbers and the job losses continue to be under that number that we're watching, which is 320. If you had 3 months of over 320, I'd start to get worried. Mm-hmm. But I just don't think you've got any signs here that we're going into a recession. We may be going into a slowdown. And how do you play that? I think that you just need to take a look at the stocks, model them out. I know you don't like the word long-term, but model them out on a long-term basis and see what the compound return is. And if it makes sense today, you buy it.
It's true. Guy doesn't like long term. It's always, that moment. I'm kidding. So to that point, though, I wonder how much cash is out there on the sidelines to do stuff, in that we've seen a lot of money go into bonds, right, because you're getting higher yields now. We already are pretty much paired any sort of underweight in the equity market. Tech is overbought. This is the fund manager survey that I'm talking about. Is there the will/money to go in and buy the dip again?
I think that there's a lot of cash sitting on the sidelines, and one of the areas that we're seeing it is some of the alternative spaces where you've had some of the longer term pension money. They're really full on that allocation. They continue to have inflows that need to be invested. So incrementally, I think that we're positive in terms of flows into the equity markets. Yes, bonds still have yield, but in a rising tide in terms of a market which is going to have positive economic growth, and also a market where you have inflation, I think that equities offer you some of the best protection out there.
Katrina, this time next year, will the Fed have cut rates? In the kind of slowdown that you're talking about, does the Fed need to cut rates?
I think if the Fed does cut rates, it'll be a very small adjustment. The one thing that the Fed has continued to emphasize to us is this data dependency. And that's really new language that's come out in the last couple of years. So I think that trying to predict what the data is going to say in 12 months' time is difficult. As you've heard, we're positive, which would lean towards the fact that we won't need that rate cut. But if it's not quite as good, and maybe that inflation number, while it's coming down, we start to see a pickup in unemployment numbers, the Fed may need to cut just a little, but I want to emphasize a small cut. We're not looking for some of the, the reversal of the rate hikes that we've seen over the last 12 months.
Katrina, great stuff. Thank you very much. I don't mind the long term. I can't remember last week. The long term I'm okay with.
Tomorrow, this morning.
Tomorrow confuses me. Great stuff. It's true. Honestly, last week you asked me what we did. Not a clue. Katrina Dudley, Franklin Mutual Advisors. Thank you very much indeed. Too much noise. There's way too much noise around at the moment. Okay, talking of noise, Hollywood Studios making a new offer to striking screenwriters. I thought so. The Writers Guild seeking assurances about AI. AI, it hopes, will not replace them. We're going to have details. We're going to take you to San Francisco next. This is Bloomberg.
It's 23 past 7 on the West Coast. We want to get to the startup. The top tech stories from the Bay Area and beyond, where Silicon Valley starts its really beautiful morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, okay, San Francisco, but let's go a little bit to LA. We have the writers strike. We have the writers union coming together with the studios for maybe a little bit of movement here.
So, according to sources, there was a meeting on August the 11th and a new offer has gone in from the Alliance of Motion Picture and Television Producers, which represents the studios, to the writers only. And what they're basically saying is, we'll meet you halfway on pay, 5% salary hike for year one on a 3-year contract. The writers wanted 6%. A much improved offer around residual payments, which is when you write a show and it then ends up on a platform for which it was not originally destined. And you would have seen a lot of coverage in the press about how that's a real complaint for writers. They have shows that have aired hours and hours and hours, hundreds or thousands of hours on other platforms years after they were made. They never saw any money for it. So this is what we're hearing from sources. The offer's gone in. Key, though, the agreement to credit writers, human beings, and not artificial intelligence.
Where does this leave the thespians, the actors? Do they have a similar deal coming down the pike?
I knew you were going to ask that, and we don't know the answer. I mean,
Sorry.
What we do know, it's okay. I mean, what we do know is that the combination of the writers and actors strike has impacted so many film and scripted TV series that are basically ground to a halt. They're not in production. I pulled up a list because I knew that you were going to ask me this. The Rings of Power, the follow-up to Amazon's Lord of the Rings TV format, is currently impacted. House of Dragon, HBO. I don't know on the actors' side. What we do know from sources is two key names are now getting involved. Ted Sarandos of Netflix, Bob Iger of Disney, and that on the writers' side seems to have moved things along.
You know,
those are two shows that Alex is not going to be happy about. I'm just going to point that out.
I did that for her. She's a big Dungeons and Dragons fan. I thought she'd be like, oh, those are great.
I didn't see House of Dragons because I just couldn't keep up with like all the different characters that just kept dying and being put in. But of course, I saw Rings of Power. I mean, obvi, but you know, anyway. Wasn't that great, but we'll see. Like, I'm definitely gonna watch it. We have like 10 seconds, but I'm wondering, like, who succumbed first? Was it was it like Bob Iger that's like, let's get this done?
Sarandos, Ted Sarandos, Netflix co-CEO. Sources say he was the driving force. Iger has joined more recently. The meeting was August 11th. We have no idea if they'll accept this latest offer. At least we know the offer's gone in.
Okay. Well, I'm glad our writers aren't on strike. Great stuff, Ed. Thank you very much indeed. Nice to see you. Ed, otherwise it's just Alex, me, and occasionally Ed Ludlow. Anyway, Ed will be back very soon. We're going to talk about European gas next as well. There's a pivot.
We're about an hour into U.S. trading session. Yes, volume is light, but a real risk-off day developing here. The S&P is almost down by about 1%. Abby's tracking the moves for us. Abigail?
Yeah, for sure. We definitely have a sell-off on our hands, Alex. That S&P 500, as you were just mentioning, down 0.9%. And there may not be volume, but there is breadth to the sell-off. Apple is the top point decliner for the S&P 500, dragging the most, down 0.9%. But ExxonMobil, JP Morgan Chase, right behind. So it's rare to see all these different sectors participating. And on the month right now, the S&P 500 down about 3%. This, of course, has the VIX higher. That is the worst monthly performance of the year, the worst decline on the year. The VIX, as you can see over the last few weeks, started to trend higher, not quite at that 17 handle it had been. In fact, right now, the VIX feels a little bit orderly relative to the degree of selling, but let's wait as the day goes on. And as for the S&P 500 itself, well, from a technical standpoint, last week, or a couple of weeks ago at least, we were tracking a bearish divergence, which was that rally out of July on a falling RSI. You can now see that it is below that uptrend and perhaps declining guy right to the bottom of that trend channel there, suggesting more declines, more pain could be ahead for stock longs.
All right, I'll take it from there. Abigail, thanks a lot. Really appreciate it. We are seeing commodities get hit very hard as well. Oil off over 2%. One commodity that's able to kind of eke out a gain here are European natural gas prices. They're up about 3%. You do have disruptions out of Australian LNG areas. You also have some Black Sea shipments continuing despite the fact that there's been some issues with vessels there. Natalia Knežević is joining us to track the moves. Natalia?
Hi, Alex. I would like to start with grains and wheat futures. So we know that Russia exited from the grain deal. The reason why it is so important that if we look at this full screen, we see that grain corridor was accounted for the majority of grain flows coming from Ukraine. So before the end of this deal, flows went through three main terminals, Pivdeny, Odessa, and Chernomorsk. Right now, it's just one port. It's basically a non-official corridor through Danube, and flows go to Romania and some other destinations. So, but also one of the main reasons why wheat futures are moving lower is because we just have really good harvests around the world. And let's talk about gas now. We do see this spike in European gas futures, and one of the main reasons, of course, is because there is a risk of supply disruptions coming from Australia if we do see this strike of LNG workers. But what we should keep an eye on is how Europe will be dealing with gas storage and gas distribution this winter. So gas storage is really above seasonal levels right now in Europe, and what some European and global traders are doing now, they're trying to use Ukrainian gas storage as an opportunity. So this chart shows this picture really well. So we see that flows go from countries like Poland, Slovakia, Moldova, and Hungary right now. So we do know that also Ukraine offered traders at least 10 billion cubic meters of underground facilities. And the reason why also it is so important is that we no longer have flows coming from Russia through Nord Stream 2. So basically, this chart shows it really well. So now the main flows go through a Ukrainian Sudzha terminal and also through Turkey.
Natalia, great stuff. Thank you very much indeed. Let's carry on the conversation and figure out, particularly on that gas story, what is happening. German Galushenko, Ukraine's energy minister, joins us now. He joins us from Seattle. He's at the Net Zero Initiative, the ministers' meeting that is taking place there. Minister, thank you very much indeed for your time. Over the last few days, we have seen a lot of volatility in European gas prices. There's serious concern about what is happening in Australia, but there's a growing expectation that maybe this volatility could continue into winter. Minister, how much storage is currently being used by European governments, by European energy traders? How much of the storage that you have is currently being used by these governments and energy storage and energy traders? Can you give us a number at the moment? What should we be seeing?
Hello, yeah. In fact, that is a very important point, that the possibility to store gas in Ukraine. So we have the biggest storages in Europe. That is more than 30 PCM of storages here in Ukraine. And what we see that the trends of the previous months is that the European companies start storing gas in Ukraine, even despite the war. So, and that is a good sign for us, and that is a good sign for Europe also. So today we could say that already something around 600 million of gas stored in Ukraine, which is gas of European companies. And that is also important for the security of supply in Europe, due to the level of storages in Europe now, because it's very high. So I think that is a good solution for the business, and that is a good solution for European security.
Do you expect more coming, Minister, from Europe?
Yeah, we expect more coming. So I can tell you that we expect average something around from 500 to 600 per month. So, and we could offer so our storages, we need 15 BCM for Ukraine for the next season, and so 15 BCM is open for storing in Ukraine.
Can we talk about what you expect to happen this winter, Minister, both in terms of the situation in Ukraine and what you think the energy situation is likely to look like in Europe?
I think that's very important. I mean, when we are talking about the gas, that's very important instruments which already started in the European Union. That is the joint purchasing platform, which would allow not to speculate the prices and manipulate the prices. And I think that is a very important decision. Concerning the Ukrainian energy system, of course, we are preparing for another hot winter. So, and I just recall you that the previous winter, we were living under everyday massive attacks on the energy infrastructure from Russia. So it started from the 10th of October, and the last massive attacks one was on the 9th of March. So, and it was every day by all kinds of weapons. So now we are preparing for the next winter, and we are not expecting that they wouldn't shell our energy system.
What alternatives do you have, though, if some of your power lines are seriously damaged? Do you have to import other energy for your own use?
That's a very important option for us. So, and I can tell you that the options which we used the previous winter. So that is the possibility to import electricity from European Union. So we were connected to the European grid 21 days after the beginning of the full-scale invasion. And now we have this possibility to import electricity from Europe.
In terms of what you've been able to manage this summer, to what extent have you been able to build up reserves of key equipment, transformers, etc., that will help you deal with the situation as it progresses this winter?
That's what we are working on right now, and we were working before. That's a very important point, because we need this reserve, not only equipment to repair and to substitute the destruction of the system. We also need to increase the reserves. And here I mentioned that we have a constant assistance and from our partners, and that is supply of all kinds of equipment in kind, and that is also the donation of the money to Energy Support Fund of Ukraine, which allowed us to buy the necessary equipment.
Minister, could you tell me what conversations you have also with the U.S. on energy? Obviously, when there are issues in the Black Sea, particularly when it comes to oil vessels, you see a price spike, and the U.S. doesn't really have a lot of options when it comes to deflating an oil price spike. Are there conversations that happen?
Of course, we are in constant consultation with U.S., with DOE, and with all our partners. And I can tell you that, of course, we are monitoring the situation very closely, and so we are preparing and we are discussing different solutions.
Okay. Let's just talk about what's happening with your nuclear facilities, Zaporizhzhia. Minister, can you just update me on what the latest is? This is the big fear that we all continue to have, that something goes wrong. Zaporizhzhia may be one of the other facilities as well. What is the situation as you understand it currently?
I can tell you that the situation becomes worse and worse. And that is not only our opinion, that is what is confirmed by AIA, experts on the grid. And so today they stopped the the fourth reactor, they start to move fourth reactor to the cool regime, but because of the equipment problem. And that is the first signal that there is a destruction of the equipment in Zaporizhzhia and PP. That's what we also messaged to AIA, and we discussed this in details, because that is the biggest threat, is that is still 60 units, and the equipment become worse and worse, and that is the issue of nuclear safety and security.
So before I let you go, Minister, let's just tie this all in together, because we've talked about storage, we've talked about power lines, and we've talked about the port, and we're talking about nuclear as well. In terms of the infrastructure, what do you need in terms of the infrastructure to make sure things can run smoothly and store well throughout the next few months?
I can tell you that the best solution, what we would have from the point of view of the energy, that is the air defense systems. And that's what we need really more and more, because that is the best way to protect our energy infrastructure, and that we see how it works. So that's why I can tell you that we would be ready for the next winter from the point of view of infrastructure, from the point of view of resources, but very important is to protect our energy system from the missiles attacks.
All right, Minister, thanks a lot. We really appreciate your time today. Thank you very much. Germain Galushenko, Ukraine's energy minister, thank you. Just to update you, markets continuing to roll over here. The S&P off by about 1%. You got the big guys. You got Amazon, Apple, Microsoft, just for the big weights there. We're going to keep you updated on the markets. All right, coming up now, we're going to get the real read on the consumer with the president of RealReal to discuss retail resistance and more. This is Bloomberg. retail sales coming in really strong. Also, the previous month revised higher, and that led Guy and I to talk about the consumer and why it's fighting the Fed just so much. Is the consumer fighting the Fed? It does feel like the consumer is going nowhere quietly into the night. So joining us now for her take is Rati Shahi-Levesque, President and Chief Operations Officer of The Real Real, which is a luxury consignment store. Rati, I'll explain to Guy about Real Real, so he's all in it now, so he gets it. Give us some insight into how Real Real sales and consignment track what the economy and the consumer is doing.
Yeah, it's super interesting. So, we always say that the market sets the price. The Real Real doesn't set the price. We've sold almost 35 million items at this point, intaking millions of items every year. Everything from, Birkins, Hermes Birkins, to Chanel handbags, to also clothing, ready-to-wear, and accessories. So we'll price the item, we'll take it in, we'll process it, authenticate it. That's super important. We have gemologists and watchmakers on staff, and the market, will pay what it will pay for these items in the resale space.
Morning, it's Guy. So Alex really did have to do that. She walked me through it. The whole consignment thing is a word that I had to figure out, but anyway. Rati, talk to me about, is anything changing though? Are you noticing any trends that are emerging? The consumer is, if you take a look at the retail sales numbers, the consumer is clearly slowing down. How does that show up in what you're seeing?
Yeah, so it's interesting. I mean, over the years, let's start back, we went public in 2019, and we did see COVID hit shortly after that, unfortunately, and we did see a little bit of a trade down effect happened post-COVID. And so I will say right now for us, I can only answer for The Real Real, we're seeing actually something really interesting happen where the market is now going back to pre-COVID numbers as far as what will a consumer pay for something. So when I look at our conversion numbers, conversion is very healthy on the demand side. When I look at average selling price, like-for-like items are actually up. Our average order value is up 10% year over year. So although our consignors are being more mindful in what they're buying, they're actually spending more on those marquee items. I'm talking handbags, fine jewelry, watches. So it's really interesting. Yes.
But otherwise, clearly a Birkin bag is going to be different than frame jeans, right? So I'm wondering how the regular products, are you having to discount a lot to get the same kind of volume?
We're not discounting as much as we did during COVID, and I will say that the numbers actually are flat pre-COVID. So when I go back to 2019 numbers, the numbers are flat as far as average selling price. Again, if anything, average selling price for like items are up year over year. So us being a value play helps when these prices are already marked down 70-80% from the MSRP, we call it, the retail price. You already are factoring in the value there.
Everybody's talking about AI. Let's talk about it through your lens. Is The Real Real going to be an AI company?
Yeah, so, we use AI, and we always have, in many different ways. Our value prop and our moat is around our authentication process. So that's really where we stay focused. And what I mean by that is most of our handbags in a year will be authenticated via machine learning. So, we have a piece of hardware. We're monitoring things on the pixel level. We have gemologists and watchmakers. We patent technology with the University of Arizona to measure the melee on diamonds, to get the read that is most accurate. You'll see it being used in our call center. We're really focused on, luxury service for the consignor, as we're a supply-constrained company, and most things sell through on the demand side. So you kind of have to reverse the way you're thinking about things. So if we are going to invest on the tech side, we're going to invest on the consignor, in the consignors and their experience with The Real Real.
Rati, before we let you go, there's so much more to ask. Before we let you go, in terms of your actual, say, retail store presence, and also when you're just your back channel, what is your hiring looking like? Are you having to pay up more for people?
Yeah, I would say that it depends on the role. Some roles, yes. It depends on where we are. Authentication centers in Arizona. We have our retail locations, and then we have our sales team. I'd say during the Great Resignation, things were a bit harder, but I'd say, again, we're pretty much flat year on year as far as payroll goes.